Hello, everyone. Welcome to the PwC Tax Bite podcast series. My name is Pieter Dree, and I'm sitting here in my virtual recording studio with Jean-Philippe van West, senior counsel in our team. And yeah, Jean-Philippe, we're sitting here because today could have been a historic day. And we're also sitting here with a big pile of paper because we're going to talk about the Pillar 2 and the developments around Pillar 2 in Europe and at the OECD level. Today could have been a historic moment, indeed. There was an ECOFIN meeting, and the French presidency was pushing to get an unanimous agreement on the draft text on the Pillar 2 implementation in Europe. What we have heard for now in the media is that that historic moment has not crystallized today. A number of countries stay against the current draft text of the proposal. For instance, Sweden wants a bit more time to get an agreement. Some smaller countries we hear still want even more flexibility to implement the rules. So basically, they want a delay to implement the rules. And the current draft text already provided for the option to have a 5-year delay of implementing the rules. But apparently, some countries are not accepting that. And it was a good attempt of France to get an agreement. But at this moment, there is no agreement. But still, Jean-Philippe, we have a lot to talk about. It's a historic development the past days, I guess.
Yes, indeed, Peter. And let me start with the beginning and what happened at the beginning of this week on Monday. So on Monday, the OECD published the long-expected commentary to the OECD Pillar 2 model rules. This is a quite lengthy document. So the commentary itself is 228 pages and is accompanied by a document with examples of approximately 50 pages. So together, a lot of materials to read. What is important there is that the commentary, the commentary to the Pillar 2 model rules is approved by the OECD G20 inclusive framework. It was approved on 11th March of 2022. However, if you look at the document with the illustrative examples, there you read that it was prepared by the OECD Secretariat and did not seem to have received the approval of the inclusive framework. So there, important difference.
Yeah, and the audience will immediately hear that although these lots of pages were only published yesterday, that we spent the entire night reading them, and indeed we went through them, Jean-Philippe. And I noted that as well, that the examples were not approved by the inclusive framework, but still I see quite some detailed examples with numbers. So are they not helping us at all, the examples?
Of course, the examples are useful. One can, of course, question the legal value of these examples if they're not endorsed by the inclusive framework. So that's one point. Another point is indeed they're useful. They help understand the rules. What is my impression is that sometimes you have the feeling that the examples are a bit oversimplified, and of course that they deviate from what happens in the real world.
Yeah, I must say that I agree with you on that point, Jean-Philippe. When I was reading the examples, and I'm not going to cite a lot of examples in the podcast here, but there's one example that really illustrates for me the simplicity. There is an example where a company receives an income of 200, and half of that, so 100, is a dividend which is taxable in that country. And under the tax rate of 20%, they end up with a taxation of 40. So the 200 results in a full tax of 40. Of course, for the globe income determination, you have to eliminate that dividend. But because that dividend is also taxable in that country, you also have to eliminate the tax effect. So of course, in this example, it's easy. It's half of the income which is corrected. So it's also half of the income, half of the tax, apologies, that you need to correct. And in the example, the conclusion is that there is an effective tax rate of 20. Of course, if all countries would have had a tax system this simple and this easy, it would be easy to calculate. But we all know the reality. There are much more deviations, much more changes in tax systems. So it's going to be an extremely difficult job, I think, to apply this example in practice. So I think examples are a bit simplistic, but on the other hand, when you were reading the document, were there any big surprises on your side, Jean-Philippe, on the commentary itself?
Let's say that broadly speaking, my key impression is that the commentary is in line with the model rules, generally in line with the model rules. It tries to explain the model rules to bring them in a more so that you can read them in a more accessible way. So it helps to understand the model rules. However, from a technical point of view, sometimes the rules do not go as far as we would like to be them. So there are still some unclarities and a number of outstanding issues there. And I think, and this, so if I'm providing an example there, what I mean with that, at some points the commentary is useful, provides useful additions, but does not go as far in detail as we would like to be, is what with historical tax assets. So pre-regime tax assets before tax assets that have their origin before the implementation of Pillar 2. Where, well, there, as we know, in the OECD model rules, it are the transition rules that are important there. And there, the commentary provides helpful guidance with respect to the pre-globe losses under the transition rules. However, there's still, according to my reading, uncertainty exists for the implications with respect to other pre globe attributes, tax assets. So it's such as tax credits or so that you might have. Another point when reading the commentary which is useful to mention, or which is important for me, is that we know we have under the Pillar 2, we have the two key instruments for collecting this potential top-up tax. We have the income inclusion rule and the undertaxed payment rule. If we go back to the Pillar 2 blueprint from October 2020, this undertaxed payments rule really required a payment between two constituent entities. Under the Globe rules published or released in 20th of December 2021, there it seems that no actual payment is needed, and that is undertaxed payment rule can also kick in if there, even when there is no payment between let's say a high taxed entity and a low taxed constituent entity. And this seems to be, if you read the commentary, this seems to be there as well, confirmed there if you read the commentary. So that's a second point there, besides the useful guidance on historical losses. A third point that I was, when reading the document, is that I do not read anything or no confirmation whether guilty will be a qualifying income inclusion rule or not a qualifying income inclusion rule. So there's still a lack of guidance and still uncertainty. But so these were three of my key takeaways. But Peter, anything from your side, because you read the documents as well, and I'm sure you put some as well explanation marks at some points at the document.
Yeah, absolutely, Jean-Philippe. Exactly, with an exclamation mark. One very particular point that always strikes me, and it was there, of course, it was there already in the model rules, but it's now explicitly reconfirmed, is the fact that you can have a top-up tax if you have no income. So the situation is that in case you would have a loss in a jurisdiction, let's say that under the national rules you have a loss of 120 in a country, and under the globe rules your loss would be smaller, so you would only have 100 of loss for some elimination that should happen under the, for instance, the globe income determination. Well, for that difference you can be subject to globe tax. So basically they say, although the globe loss is only 100, we will tax you on the difference with the statutory rules, so the 120. So the 20 is subject to globe tax, and in exchange, you are able to deduct from your globe base at some point 120. That's like very difficult for me to understand because companies that make losses already have difficulties in cash flow and so on. Levying a top-up tax feels very contradictory to me to the purpose of the top-up tax and the broader purpose of the globe rules. So that's very striking. And the second thing I noted when reading is that in the entire tax determination of the globe rules, so you start from deferred taxes. That was a principle which was already there in the model rules in December, and it's of course reconfirmed. But there was this globe loss election. So basically, there was the opportunity for simplification reasons to determine your losses under the globe rules in a more easy way, just by multiplying your loss with the 15% minimum tax. It was not fully clear whether this globe loss election was an add-on to the rules to determine your covered taxes based on DTAs or not, and it appears not to be. It's a choice. Either you apply the system of deferred taxes, which allows you to eliminate timing differences between the tax rules and the globe rules, or you put that aside and you go for the globe loss election. So that means that this simplification rule is probably only going to be used in situations where in the jurisdiction there is very limited complexity, very limited timing differences and other deviations, and where there is a loss. So I think that limits a bit the impact of this simplification rule, Jean-Philippe. So yeah, these were just two examples, but there are a lot of things in there. And what struck me as well is that there is often a reference to the implementation framework. Did you note that as well?
Yes, yes, indeed. So quite often when reading the document, you see something, this will be further clarified by the implementation framework. Maybe for the listeners, what is the implementation framework? Well, all this pillar two model rules, they will have to be implemented into domestic law. So the income inclusion rule, under tax payment rule, the calculations of the effective tax rate, and to provide for a coordinated implementation and as well administrative guidelines. How do tax authorities will have to deal with these rules, have to implement them. They will they will establish this implementation framework that which should then lead to a coordinated implementation. What is important there is that together with the publication of this commentary, together with these examples, a public consultation was launched on the implementation framework. The comments are due, comments are due 11th of April. So let's say a few more, 4 weeks, so about a month from now. What is there, interestingly, there's not a consultation document, but it's rather an open question with suggestions of how this implementation framework, what actions or suggestions you would have for them. Important there that that this implementation framework, this input, is not on the policy rules on which they agreed, but really deals with the implementation. So how to the implementation, how to implement the rules. If we then look into the text and providing some examples on when, on which occasions do you then is then referred to this implementation framework. There I have two concrete examples. The first one is with respect to the interaction between Pillar 1 and Pillar 2. So as you are all are aware, Pillar 1, the reallocation of taxing rights to the market jurisdictions of the largest and most profitable multinationals. Well, there, no clear guidance yet. It's written that this will be further addressed through administrative guidance to be developed as part of the implementation framework. So one important aspect, that interaction with Pillar 1. A second one, where you read that there is references made is to this implementation framework, is with respect to the safe harbors. So as you know, the safe harbors, they will deal with situations, as you know, Pillar 2 will lead to a significant increase of the compliance burdens. So that's one of the main challenges for business, this implementation of Pillar 2 to how to be compliant. Well, under this safe harbors will provide for in certain situations solutions, so that you will not have to go through this whole compliance burden for a certain jurisdiction, but that, for example, potentially still to be agreed upon, but a potential simplification measure could be that if, for example, based on CBCR, your effective tax rate is a certain percentages above 15%, that you will not have to do all these complex sets of calculations for calculating the effective tax rate in this jurisdiction. Well, on this simplification measures, this will be further developed within this implementation framework, which is of course an important element of the Pillar 2 rules, and something for which business will have to wait. Apparently, still will have to wait still a bit, because no guidance there in the commentary yet.
Okay, well, I think Jean-Philippe, we are reaching a little bit the end of the podcast. I think in summary, I think we will need more time to digest it. I think that the commentary from me is providing useful guidance to interpret the model rules. The examples are useful, although not approved by the inclusive framework yet. They are helpful to understand the commentary. And I think for me, the red wire in the entire debate is that I was surprised by the complexity of the model rules. When I read the commentary, I think we are even underestimating the complexity that this will bring to just be compliant and do the calculations. So I think your comments on the implementation framework are, for me, spot on, because there is still an opportunity to implement these rules in a way that it's doable, I think, for business to be compliant. So we will definitely have another reading in the next days. But the ECOFIN meeting, Jean-Philippe, perhaps I'm interested to have your view on that. Will France, now that unanimity was not reached this morning, do you think they will give up and that the plan will be delayed at European level?
There indeed. So we had this ECOFIN meeting today. As we know, before the ECOFIN meeting, there France came with a compromise text. Indeed. So as you mentioned at the beginning, where in this compromise text, the day to be compliant with the directive, this draft EU directive that was released on the 22nd December 2021, so just before Christmas, the day to be compliant with this directive was moved from 1st January 2023 to 31st of December 2023. So which would give EU member states 1 year more to be compliant or to implement Pillar 2, and as well business, giving it 1 year, one extra year to prepare for Pillar 2. It was, let's say, it could be this was seen as potentially leading to an opportunity for reaching consensus, which is needed for an implementation directive in the area of taxation within the EU, and that the first step would then be reach consensus at the ECOFIN meeting, so where the finance ministers of EU member states come together. This was not reached, this consensus. However, this does mean that all plans are abolished, and for sure there will be future occasions where where France will try to reach this consensus, because as we know, both the Commission and as well France are a big supporter of Pillar 2 and will do, let's say, everything what is possible to reach this consensus during, especially France, during its presidency. So definitely more to come.
Absolutely. Thank you for joining me, Jean-Philippe, in the virtual studio here. I hope we can exchange the virtual studio for a real one very soon, but that we will see in the future. Thank you for coming. Thank you for the audience to tune in and listen. I'm sure we will have other podcasts on the global minimum tax in the next weeks and months to come. Thank you. Have a great day.